In today's video, we are going to take a look at why the Fed's decision on changing the interest rate will affect the stock prices. Hello and welcome. My name is Peter B. and I welcome you here at My First Million, where we are achieving our financial goals together. Following the news, whenever you hear about the Fed changing the interest rates, whether it's going to increase the interest rates or lower the interest rates, this decision is always highly discussed in the financial news channels. But why is that so? What's the reason for that? This is the topic of today's video. We are going to take a look at exactly why this is happening. And to start this exploration off, I start with a very simple question. If I were to give you $1,000, would you want to get this $1,000 now, immediately? Or would you prefer to get it in 10 years from now? And why? Think about this. You want to have it now or later? And why now or why later? So to answer this, there's a saying out there, a dollar always is worth a dollar. But is this really true? No, unfortunately it isn't. Because we need to take time into consideration as well. Depending on the time, the dollar will be always a dollar, but a dollar can worth more or less now or in the future. A dollar today does not have the same worth as a dollar in the future. This is also called the time value of money, which is basically saying a dollar today is worth more than a dollar in the future. And why is that so? Let me make this a little bit bigger so it's a little bit more easy to read. You can see here at different interest levels. Usually our interest level is above 0%. But at 0% and maybe with zero inflation, you could argue $1,000 today in year one is the same worth as $1,000 in year 10. However, with interest rates above 0%, there will always be a cost of opportunity to delay getting the money. Because if you have $1,000 today, you can, for instance, invest them into secure treasury bills, for instance. So if you get 5% at zero risk in a treasury bill, after 1 year you will not just have $1,000, but you have $1,050. And if you let this continue to compound over the years, after 10 years, you have more than $1,500. So this means at a 5% risk-free rate, $1,000 today is worth the same as $1,551 10 years from now. So I hope when you answered the question before, whether or not you want to have the $1,000 now or in 10 years, you answered now. But if not, now you know why you should be answering. You want to have the money now. So now, how does this knowledge affect the stock prices? Basically, there's a module called discounted free cash flow. So in the discounted free cash flow, the theory is saying a company should be as worth as much as all the future cash flows discounted to the present values. So taking this into consideration, the value of the company really depends on when is the company getting the cash flow from its business. And basically there are different types of companies out there that you can invest into. And I try to group them into 3 different groups of companies. First, you can see here the red line. The red line are declining businesses. Declining businesses earn a lot of money or have huge cash flow at the beginning or now. But maybe they're in a downtrend and their future prospects are not very good. So they earn less and less in the future and have less and less cash flow in the future. So over time, you will receive less and less cash. Then there's something like, I would say, the stable businesses who are basically cash cows, who always provide a certain kind of cash flow. Maybe it's not flat like in the example here. Maybe sometimes it's going a bit up or sometimes it's going a bit down, but it's more or less stable. So you can see here, stable business cash flow today is maybe similar like in 10 years or in the future. And I think the most easy to understand are growth businesses. Growth businesses often don't have positive cash flow now, or even have negative cash flow, or at least don't have big cash flow now. But the investing story there is you will expect them to have a very bright future and earn a lot of money in the future. So now you can see that some businesses have a lot of cash flow now. Some businesses will have a lot of cash flow in the future. So does this matter? Coming back to the $1,000 table. If the interest rate is at 0, this doesn't really matter, because even in the future the $1,000 are still $1,000. But the higher the interest rate is getting, the more it matters. So if a company is earning $1,000 in 10 years from now with 5% interest rate, this $1,000 will be worth less than $1,000 today. So how do then interest rates affect the stock prices? And the main question here as an investor is not what is the interest rate now, because whatever the interest rate is now, it's already priced into the stock price. The main question is, how is the interest rate going to be in the future? So, and I tried to draw this out in this simple graph here, and you can use this as a reference whenever it comes to the discussion of rising or decreasing interest rates. Basically, if interest rates are going to increase, this brings a lot of pressure on growing companies. So growth stocks will hurt the most with increasing rates. Stable companies also will hurt, but maybe less severe. But even declining companies will hurt more or less, but not as much, because the cash flow is coming in pretty soon. So when the Fed is changing the policy to decreasing the rates, this will especially benefit growth stocks, as they have their cash flow mainly in the future. So the future cash flow is, with decreasing rates, worth more today. So therefore, their stock prices is pushed up the most. Stable companies also potentially see a push up, and declining companies also will profit from lower rates, but not as significant as others. So of course, interest rates are not the only economic factor that play into the markets and into the market cycles. But at least now you should be able to identify that if everything else remains equal, an increase in rates will affect companies negatively. So the stock prices usually get pressure, especially those of growth stocks. But a decrease in rates has the opposite effect. It will have a positive push for the stock prices. As said, this is considering everything else remaining equal. What are your thoughts on changing interest rates? Are you even taking those into consideration when you make an investment decision? Please share with us in the comment below. Thanks a lot for joining me today. I look forward to seeing you in the next video, and especially I look forward to seeing you winning financially.